So you want $5,000 a year in passive income, and you've decided that a dividend portfolio is the best way to go. After all, dividends paid by high-quality companies are reliable, and they usually grow at an inflation-beating rate year after year. Unlike stock prices, which go up and down at the whims of buyers and sellers, dividends generated by blue-chip companies usually move in only one direction. I mean, look at the beautiful staircase patterns showing decades of dividend growth for every one of those great companies. Home Depot, up. General Dynamics, up. Pepsi, up. Johnson & Johnson, up. Automatic Data Processing, Sherwin-Williams, McCormick, up, up, up. So with this in mind, how much money do you need to invest in high-quality, dividend-growing stocks to generate $5,000 a year in passive income? Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I kick it into gear on this topic, please do us a favor to help us grow our channel. Punch the thumbs up at the bottom of the video, subscribe to the channel, and ring the bell so you get notifications of new videos as we publish them. Now let's get back to talking about that $5,000 of annual income you want to generate. In short, the amount of money you need to invest depends on your portfolio's dividend yield. A company's yield is easy to calculate. It's the annual dividends per share divided by the current stock price. For example, divide Morgan Stanley's $2.80 annual dividend by its recent $98.21 stock price, and you get 0.0285, or a yield of 2.85%. To calculate the annual yield of an entire portfolio, you add the projected annual income of all positions and divide it by the dollar value of a portfolio. In this sample portfolio, the annual income, $2,158, is divided by the portfolio value, $78,838, 0.02737, 2.74%. Given all that, here's a table showing investment dollars needed to produce $5,000 a year based on various yields. So a portfolio yielding 1%, you'd need $500,000 to generate $5,000 a year in income. 2.5% yield, you'd need $200,000. 4%, $125,000. 6.5%, around $77,000, and 9%, you'd need $55,500 or so. Obviously, you could do this with any percentage that isn't listed there. I just needed to choose a few for this example. To illustrate this further, let's take a look at our real-life, real-money project, the Income Builder portfolio. At the end of November, the IBP had a market value of $129,975 and a projected annual income stream of $3,315, meaning it had an overall portfolio yield of 2.55%. One reason I selected $5,000 for this video is that the income target for the IBP is $5,000 by the end of year 7. It hasn't quite been 4 years since we launched this portfolio in January 2018, and we're already 66% of the way to our target. At the start, the $5,000 figure assumed a 2.5% yield and 5% dividend growth. I played it pretty conservative because I didn't want to have to chase yield to achieve the goal. I always want to emphasize quality first, but any investor can adjust those percentages to fit their dollar needs and to their risk tolerance levels. I'll have more about the IBP in a bit, including our November transactions and dividend activity. But let's talk for another minute about getting the income an investor might want. Obviously, you might have a higher income target than $5,000 a year, and that's okay. Any portfolio is scalable. In other words, if you find a combination of stocks that you like, that portfolio could work whether your income goal is $500 or $5,000 or $50,000 or $500,000 or any other number. Like let's say you're 2 years away from retirement and you want $25,000 in annual dividends to augment whatever Social Security, pension, or other income you receive. In that case, the numbers in the earlier $5,000 table would need to be multiplied by 5. So to generate $25,000 in income within 2 years, you'd need $1 million in investments yielding 2.5%, or $625,000 in investments yielding 4%, or $384,615 in investments yielding 6.5%. Getting to one of those levels in 2 years might seem daunting to some of you, which is why we advocate saving and investing early and often. Look, these are simplified calculations to be sure. They don't include dividend growth or reinvestment, which are important parts of most passive income strategies, and they don't account for inflation, which was benign for more than a decade, but recently has become more fierce. To bring those variables into play, you need to do a lot more research or consult with an investment advisor. You might be wondering why not just load up my portfolio with stocks yielding 9% or more. That way I don't need to invest as much money to generate the passive income I want, right? Well, in general, higher yielding stocks tend to be more volatile, and they often are in less stable or highly cyclical industries. I happen to agree with the folks at Investopedia who say that a high dividend yield might indicate a business in distress, and it could mean a dividend cut is coming. The yield could be high, Investopedia says, because the company shares have fallen in response to financial troubles. Personally, whenever I look at high-yielding companies, I wonder if they have the cash flow and overall financial health to keep their dividends going. Do they have realistic payout ratios? Have they demonstrated over the years that they have a commitment to paying and growing their dividends? Do they make money year after year after year? Do they have competitive economic advantages within their industries? Do they have their debt level in check? Again, quality is my first, second, and third concern. Then I think about yield. Of course, quality is subjective. To try to make it a little more objective, my colleague Dave Van Knapp has developed Quality Snapshots, a simple system that assigns 1 to 5 points for each of 5 categories provided by respected agencies and investing services. Here's one Dave did for Johnson & Johnson. J&J got the top mark in every category for a perfect score of 25. No wonder it's found in so many income-oriented portfolios, including the IBP. To check out Dave's article on Quality Snapshots, please see the link in the description. Now let's go back to the Income Builder portfolio and take a look at what happened in the very busy month of November. The IBP's value increased 0.7%, but only because about $2,000 in new money was used to purchase stocks on November 8th and 22nd. As always, the money came from this channel's co-founder, Greg Patrick, as I'm building the portfolio on his behalf. In retrospect, that mediocre portfolio performance in November wasn't surprising, given that the S&P 500 index was down nearly 1% for the month. But still, the IBP's projected annual income stream increased by a robust 2.5%, demonstrating a point I made earlier. While stock prices can experience significant swings, dividends produced by high-quality companies pretty much only go up. The IBP's income growth was achieved through a variety of factors. 1. Companies that announced dividend increases. 2. Positions that received dividends and reinvested them. 3. Holdings that increased in size because we bought more shares. And 4. Corporate action, such as Realty Income's spin-off of Orion Office REIT into a separate company. Speaking of Realty Income, it was the IBP's most active position in November by far. I'll get to them in a minute, but first let's talk about a few other notable things that happened within the portfolio last month. 5 companies in the portfolio announced dividend increases, with automatic data processing delivering the biggest raise at 11.8%. That makes up for last year's unusually small 2.2% hike. I say unusually small because ADP has averaged 12% dividend growth over the last 20 years, and it's a dividend aristocrat with nearly a half-century of annual raises. Pinnacle West Capital scared away some investors when it reported that Arizona utility regulators pushed through a rate package that would reduce profitability in the near term. There was concern that the company would have to cut its generous dividend, so it was a pleasant surprise and even a bit of relief that Pinnacle instead came through with a small raise that sent its yield past the 5% mark. Pinnacle's stock price at first fell on the bad news involving utility rates, but it started to recover. The 2.4% dividend increase sent a signal that management believes in the company's stability and its future. I also like that Value Line gives Pinnacle an A grade for financial strength, ranking it high among its peers within the industry. 14 IBP companies paid dividends in November. In accordance with portfolio rules, we reinvested right back into those stocks. AbbVie sent the most income to the IBP, about $44. That came a month after the investor-friendly drug company announced its 49th consecutive annual dividend hike, dating back to its years as part of Abbott Labs. AbbVie is the portfolio's #1 income producer, and it's expected to generate almost $200 over the next year. We also bought stakes in 4 companies during November. On the 8th, we used Greg's $1,000 semi-monthly allocation to initiate a position in Snap-on. The commercial toolmaker became the IBP's 45th holding. That buy came just a few days after Snap-on announced a 15.4% dividend raise. That's a typically wonderful increase for the company, which has boosted its dividend by more than 300% over the last decade. The month's other main buy was Realty Income, the real estate investment trust that has centered its entire marketing campaign around its monthly payments to shareholders. November started with the company finalizing its $11 billion acquisition of competitor VREIT on the month's very first day. On the 15th, a $6.16 dividend from Realty Income was reinvested, buying an additional fraction of a share for the portfolio. Also on the 15th, I sold the 2 shares of Orion Office REIT that the IBP had received in the spinoff, and I used the proceeds to buy another small piece of Realty Income. On the 22nd, we bought 7 shares of Realty Income for the IBP, as well as yet another fraction of a share with $13 in cash the portfolio received in conjunction with the spinoff. And in between all those transactions, on November 16th, the company announced a 5.1% year-over-year dividend hike, marking its 96th consecutive quarterly raise. As a result of all that activity, about 8 more shares of Realty Income came into the IBP. Our stake went from 26 shares at the end of October to 34 shares at the end of November, and the projected annual income from the position rose from about $74 to just over $100, a 36% increase. Along with the $500 realty income buy we made on the 22nd, we added to the IBP's positions in healthcare conglomerate CVS Health and defense contractor Northrop Grumman. I'm always looking for opportunities to build up smaller IBP positions such as CVS and Northrop, even if it's just $250 or so at a time. Small buys like those might seem inconsequential in the moment, but over time they do add up, and they can help patient and diligent investors eventually reach their goals. In addition to the link to Dave Van Knapp's quality snapshots, the description also includes a link to the Income Builder Portfolio homepage. Sign up for a free subscription to the website, and you'll get notice of all my IBP articles. Alright folks, that's all for today. Again, please give us a thumbs up, subscribe to the Dividends and Income channel, and ring that notification bell so you don't miss out on any of our content. Take it easy everybody, back at you soon.